In September 2008, the global credit system stopped entirely. Financial empires that stood for a century, like Lehman Brothers, suddenly evaporated. The panic instantly bled out of Wall Street. Harvard University suddenly couldn't access the short-term credit needed to pay its daily wage bills. Companies couldn't order parts to keep businesses running. A modern economy requires credit to function, even for a few seconds, and that flow of money had frozen. The global economy collapsed under the weight of loans handed out to people with no jobs and no assets, a systemic failure that erased $13 trillion of wealth without a single shot being fired. To understand how a bad local mortgage can shut down the global economy, we have to look at the reckless mathematical architecture Wall Street built to hide the danger. The groundwork was laid years earlier. Following the dot-com crash in the early 2000s, the Federal Reserve stepped in to stimulate a stalling economy. They slashed interest rates down to a historic 1%. With money that cheap, traditional safe investments like government bonds stopped paying meaningful returns. Institutional investors, pension funds, foreign governments, and massive banks needed a new place to put their money to satisfy their profit demands. Wall Street aggressively pivoted toward the American housing market. They operated on the historical assumption that home prices nationwide simply never decline. In the search for higher returns, lenders discarded nearly every traditional safeguard, initiating a cycle of high-risk borrowing that the American housing market was unprepared to absorb. To capitalize on the housing boom, Wall Street invented a product called the CDO, or collateralized debt obligation. Think of it as a massive box. They filled this box with thousands of individual mortgage debts, packaging them together as a single asset. Inside, a CDO functions like 3 stacked trays. As everyday homeowners pay off their monthly mortgages, that cash flows directly into the top tray first. Once that top tray is full and its investors receive their safe, fixed income, the money spills into the middle tray. Whatever cash is left over drips down into the bottom tray, which carries the highest risk but pays the highest return. This machine was immensely profitable, but it required a constant supply of new loans to function. When lenders ran out of reliable borrowers, they dropped their standards entirely. They started filling the boxes with so-called liar's loans from people who couldn't actually pay. By structuring the CDO this way, Wall Street intentionally mixed safe prime mortgages with toxic subprime loans. This setup effectively masked terrible debt as a safe investment for global buyers. So why did global pension funds and major institutions eagerly buy boxes filled with jobless debt? In the financial system, credit rating agencies act as the independent umpires. Their sole institutional purpose is to evaluate these complex financial products and grade their actual risk for the public. But there was a severe conflict of interest. The banks creating the CDOs were the ones paying the rating agencies billions of dollars in fees. If an agency accurately graded a toxic box as junk, the bank would simply take their money down the street to a competitor. So the agencies rubber-stamped toxic boxes with their pristine, highest-tier AAA ratings. Those false AAA ratings served as the critical camouflage. They allowed the rot of American subprime mortgages to bypass strict institutional safety checks and quietly infect the entire global economy. The greed escalated even further when Wall Street mathematicians engineered the credit default swap. A credit default swap is essentially a side bet. It operates as an insurance contract, paying out massive sums of money if those mortgage boxes eventually fail. But banks deliberately avoided calling them insurance. By dodging that specific label, they bypassed gambling laws and state regulations entirely. This meant a bank could place a $1 trillion bet without actually keeping any cash on hand to back it up if they lost. Through these swaps, the housing market mutated from a localized lending business into a completely unregulated, highly leveraged $50 trillion shadow casino. Between 2004 and 2006, the Federal Reserve started raising interest rates as the economy heated up. This triggered a violent chain reaction. The millions of subprime borrowers with cheap, adjustable-rate mortgages suddenly saw their monthly payments snap multiple times higher to align with the new rates. Home buyers defaulted, and mass foreclosures flooded the market. Instantly, those complex, AAA-rated debt boxes were exposed as worthless. A total panic set in. Investors universally pulled their funding. Banks stopped lending to each other entirely because nobody knew who was holding the toxic debt, sparking massive bank runs across Europe. The contagion collapsed entire sovereign nations. In Iceland, deregulated banks had eagerly accumulated foreign debt worth 12 times the country's entire GDP. When the credit crunch hit, it bankrupted the nation. The global financial system was revealed to be a fragile house of cards, built almost entirely on bad American mortgages. In the aftermath, $19.2 trillion of household wealth vanished. Faced with total collapse, the government initiated a desperate response. They utilized $2.5 trillion in taxpayer money to buy up toxic assets and bail out the exact same institutions that engineered the crisis. This chart shows how central banks kept interest rates near zero for more than a decade to prevent a total collapse. This flood of cheap money flowed primarily into assets like stocks and real estate, massively enriching those who already owned them while leaving wages behind. Meanwhile, it allowed failing, unproductive companies to survive on cheap debt, effectively stalling the innovation that drives a healthy economy. Over 15 years, this period of cheap money became the permanent scaffolding of the financial system. It created today's everything bubble, where risky corporate debt has replaced the subprime mortgages of 2008. Today, as central banks raise rates to fight inflation, that 15-year scaffolding is breaking down. We have far more debt in the system now than we did in 2008. If this exponentially larger bubble pops, we have to ask, who is left to bail out the central banks?